Consensus Hong Kong 2025 is where the global crypto community converges to shape the next era of Web3. From February 18th through the 20th, Hong Kong becomes the meeting point for leaders across finance, technology, and digital assets. This isn't just a conference, it's where deals are made, partnerships are forged, and new opportunities emerge. Consensus features exclusive networking lounges, expert-led sessions, and invaluable insights from top industry voices. Whether you're expanding your network, building your brand, or closing your next big deal, this is the event that moves markets. Visit CoinDesk.com/consensus-HK to secure your spot and use RealVision15 for 15% off. Don't miss your chance to be part of the industry's defining moment.
Hi everyone, sorry to interrupt, but this is the cheesy podcast bit that gets on everyone's nerves, but it's really important to me. Please, if you can like the channel and also subscribe, it helps me a lot to get the best guests in the world for you guys. So click like and subscribe. Appreciate it. Thanks.
Hi, I'm Raoul, and welcome to my show, The Journeyman. As you know by now, The Journeyman is my exploration into that nexus of macro crypto and the exponential age of technology. Today, we're going to talk a bit about macro. You see, macro is the lens through which I see the world. It is my 35 years of experience working at Goldman Sachs, running a hedge fund, and writing Global Macro Investor, my research service. I was one of the pioneers of using the business cycle for asset allocation, and I've found that it has been the most invaluable tool of all time. So much so that I have even gone to universities and lectured about it because it's not usually taught. The relationship between asset classes and the business cycle is the magic gift that keeps on giving. Once you understand where the economy's going, you understand where assets are going. And that applies to crypto, technology, emerging markets, the dollar, bond yields, everything, all fall within this magic cycle, the business cycle. Now, a global macro investor, I've always had a business cycle analyst working along with me. And Julien Bittel is my right-hand man. He is the greatest business cycle analyst, I think, in the world today. He, at Global Macro Investor, along with myself, have built the largest framework of understanding of the business cycle, the correlations and forecasts of which how it drives the asset classes and what it means to all of us. He's built a framework around where we are in the macro and crypto seasons, what assets are supposed to be doing well at certain times. It basically demystifies all of financial markets. And at Real Vision, we developed a product called the Macro Investing Tool to help you in that journey, to make it easy, to make it idiot-proof, to give you conviction and understanding of where things are going and why they're going there. It gets rid of all of the noise. The Macro Investing Tool is literally the single most popular thing we've ever launched at Real Vision. It comes out weekly, and it's Julien does both a video version and written versions, guiding you exactly where it is. And then there's the template of the overall asset allocation and what you should be looking at various points. So what I want to do is something special this week. Julien every month does an update on the macro with all of his charts, all of his business cycle framework. And I'm going to drop that here for you. You will find it astonishingly useful, and it will open your eyes to the power of having that kind of information from the macro investing tool at your fingertips and how it can help you in your journey. And you can get it either as a standalone product or you can get it as part of Real Vision Plus. But one thing I know for sure, because this is the single most common response of it, this has changed my life. It will change your life. Anyway, enjoy the presentation by Julien.
Join me, Raoul, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together.
Hey everyone, and welcome back to the first annual installment of MIT for 2025. As many of you may have noticed, this was supposed to be done last week, But with the trip to Miami and everything else, I decided to push it back a week because I'd have a bit more time to put the pack together, get the flow right. And also, because you had the written report, you will have known the signaling. So it wasn't as crucial that I do the video. And when I push it out a week as well, it's kind of helpful sometimes because it means that we have the ISM data. So we'll be going over the latest report for January today. But before we get into the data, what I really just wanted to say was how much of a blast it was getting to meet so many of you in Miami over the weekend. You know, I did a catamaran cruise, around 50 people. Here's got there. That's the MIT update. That was a roundtable I did. There's the roundtable still. Again, the roundtable. I'll talk about that in a second. And then what comes next? Still me just blabbering on. And then we had a thing for GMI clients, and it was more of just a low-key meetup, just because once the party started, I wasn't going to have a whole lot of time to spend with them, and neither was Raoul. So we did that, which was a lot of fun. Then we did a wine tasting with Club Divin, and of course, there I am just schooling Raoul on wine, and then me in a golf cart, of course, too many glasses of wine. And the bouffant blowing in the wind. But it was just such a blast. And the pic just before that, you saw Sergio Silva with me talking in at the party. And he actually gave me this hoodie, which is a Meetup hoodie. So I had to throw it on, had to rock it for the first show. And then I'm trying to think, but the MIT roundtable was really great because I didn't really know what I wanted to do with it in the beginning, whether it would be an AMA. No one wants to see me present because I'm already presenting, monthly. But I decided to kind of peel the curtain back behind MIT and show both the model, how it works, and then also some of the charting features on DataStream, how it is that we use the data, how we optimize lags, leads. And so I think it was really cool. And it might be worth doing a show about it at some point so that, all of you can see it. And the only other thing I'll say about that is if you didn't come this year, you got to come next year because it was really a lot of fun. And then as I was leaving, I put out a tweet on Twitter or X about how much fun it was, got in the air, reviewed a lot of the macro stuff we're going to go through now, feeling good about it, landed, still feeling good about it, landed, and someone's like, "Sir, have you checked your bags?" And not like, did you check your bags? Like, have you checked your portfolio? I did. Got home, plugged in my ledger, and added to my convictions. And so what I'm hoping this presentation does for you is there's a lot of noise out there. I mean, tariffs are not just noise. There's something in that. But when you zoom out and you look at the bigger macro picture, it's noise within a full cycle framework. So I think, as I say, I give you these. You'll have these charts like you always do. I'm going to run through them once with you, but then also, in your own time, sit down with them and try and think about them. And I think it'll help you tone down the noise at least.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
So today, slacking a little bit. I've got 84 slides, so we should be able to get through it within the hour. But let's go. I've got a lot. I'm going to end on something I think will be really helpful for a lot of you called 2021 Bitcoin's truncated cycle, because I think a lot of people are concerned about that cycle. And I'm going to talk about exactly what was going on and why I think this time it's the opposite. Okay. So let's get into it. As always, for those of you who are new to MIT, this is just a little bit of background around the different macro regimes. And then on the right, you've just got some text that I put together. But, as I always say, this is something for you to review in your own time. And if you have questions, please post them or bring them to the AMAs. But again, this is just for you to kind of make sense of what I'm talking about. Okay, the data. So at a global level, December data painted an interesting picture because we saw an increase in the percentage of countries scoring in macro summer. So that went higher. But then we also saw a rise in those shifting into macro fall alongside with a pretty clear drop in the number of countries scoring in macro spring. Now, If you remember, I had anticipated a brief backward cycle transition into macro spring last year. However, as I emphasized in the November report, the broader structural forces were always pointing towards a rotation back into macro summer. And regarding the pickup in macro fall, I see this as more of a red herring than a genuine structural shift in macro regime. Yes, inflation has started to tick a little higher in some of the countries currently scoring in macro fall. So there we have UK, Germany, Brazil, Japan, and a few others. But if you zoom out for a moment, remember that macro fall is a regime where growth momentum is slowing while inflation momentum is accelerating. And it's one of the trickiest macro regimes to navigate, not so much in terms of what assets to own, but really how much beta risk you want to run in your portfolio. And the reason being is growth is slowing and inflation is rising, which if you're running a business means your top line growth is falling. So sales are falling with the business cycle, and simultaneously costs are rising, whether that's inputs or wages. Input costs or wages are going up. So that creates a double whammy for corporate margins, which then puts earnings under pressure, which can make it a tough environment to navigate when it comes to allocating to risk assets. That said, I think the slight pickup in macro fall is entirely a result of the recent tightening of financial conditions, which, as we've discussed before, is something we've been expecting to reverse. And in fact, that's already happening. So my view is that this isn't a key inflection point into a more prolonged cycle of macro fall. So a phase of that. Instead, it's more likely a temporary speed bump. And I'll break this down for you and put on the additional layers of why I think that it's that way as we work through the slides. Okay, so very normal flow. We'll go through growth. We'll go through inflation. We'll talk about macro summer and why dips are for buying. And then I'll go through the 2021 truncated cycle. Okay. So when we look at growth momentum in December, the percentage of countries scoring an expansion bucket actually ticked higher to 58.8%. And that's up from 52.9% just 2 months ago. Now, the shift is consistent with what we saw with a lot of during the second half of last year. So a rotation out of recovery and into expansion. So very normal business cycle phasing. At the same time, and as I mentioned earlier, we've seen a slight uptick in the slowdown bucket. But for now, I'm really not concerned about this. I think the move higher will reverse soon. The other key takeaway is that the contraction bucket remains at zero, which is an important signal in itself. So from a pure growth perspective, there's just no need, I believe, to panic at this stage. The business cycle is still chugging along. And the continued surge in the expansion bucket is a very positive sign. So it's giving us clear evidence that the underlying trend and momentum remains intact without being above, let's say, the 80th percentile, which is typically where you want to be a bit more contrarian. Then if we look at the percentage of countries scoring in what I call favorable macro regimes, so expansion and recovery, we dipped a little bit to 70.6 in December. But when you step back and you consider the 8-month lead time here, I'm still very confident that we're positioned well for the global manufacturing PMI to trend higher this year and start closing the gap. And in fact, when you look at the January PMI data, this is the beauty of pushing this presentation out by one week, is we saw the global PMI tick higher to 50.1 from 49.6 in December. Now, as I mentioned earlier, much of the slowdown we've seen in some lead indicators, like here, for example, we have the OECD composite lead indicators, so the CLIs. And the slowdown that we've seen, and I've talked about this, is a direct result of the tightening in financial conditions we saw during Q4. So think dollar up, bond yields up, okay? However, as Raoul and I have both laid out independently and together across various formats, drinks with Raoul, him and I doing our macro segment together, MIT, we've been expecting financial conditions to start easing, and that's exactly what we've seen happen so far this year. So think dollar down, bond yields down, oil down. Okay? All peaked around the 13th of January. Now, let me show you some more charts on this and walk you through our thinking here, just so that we're absolutely crystal clear on how we're thinking about this and where we stand with it. So as I included in the monthly report, the first thing that we need to talk about is the dollar, okay? For some time now, Raoul and I have been drawing the parallels between the 2017 or the late 2016, 2017 cycle and the current cycle. And the following chart makes Obviously, that comparison crystal clear. The turning point for the dollar back then was mid-January 2017, when Trump, just days before his inauguration, told the Wall Street Journal that the dollar was too strong. And that single comment basically set the stage for the dollar to move lower for most of 2017. And now you fast forward to today, and we're seeing history rhyme, right? And Trump, ever attuned to the dollar's impact, hasn't at all shed away from this issue. Last year, he was saying that the recent dollar strength was a tremendous burden to U.S. businesses. And Trump knows that a strong dollar impacts the economy, right? It suppresses exports, hurts corporate earnings, and it generally just slows growth. So he knows that. And then a few weeks ago, Trump weighed in again, saying interest rates are far too high, right? And something I posted on X about. And here's why this matters. Because a weaker dollar and lower bond yields, just as we saw in 2017, becomes a massive tailwind for risk assets to rally pretty much across the board because it frees up liquidity. I also think this take from Raoul on X, which he posted, I think on Monday, is exactly right? The strong dollar today puts Trump in a powerful position to negotiate with other countries, particularly China, who desperately needs the dollar to weaken so that the PBOC can start to step up liquidity additions. So this is why the dollar is so crucial to the big macro picture, because it's literally the fulcrum of global liquidity. And as I outlined in the monthly report, our base case is that the dollar grinds lower over the course of the year. No, it's not going to be a straight line. It hasn't been so far, but to trend lower. It's also important, to understand that the rise in the dollar has already baked a soft patch into the cake. Now, what do I mean by that? Well, what I mean is that because the dollar and bond yields basically went vertical in Q4 of last year, financial conditions tightened. Okay. And that's why we've seen US city economic surprises off their peak levels back in November. And we expect that to continue lower over the near term. And I believe this setup is exactly what paves the way for the Fed to soon step in and begin easing rates further, or at least adjust their language. Okay. Because in Q4, the thing is the Fed started with all this hawkish rhetoric, and bond yields and the dollar both went higher. The point being is that the fact that the dollar went higher and rates went higher, that's done the tightening for them, right? So much so now that the Fed will need to basically cool their jets a little in terms of their language, because we're going to see temporarily, I believe, a soft patch in economic surprises. Now, that doesn't mean at all that the ISM can't work lower. I think there was some confusion about this. It just means that consensus estimates around the data, we've seen this week, actually, even with, I just closed Bloomberg, even with jobless claims and durable goods, they all came in below consensus expectations, right? So that's when you get a negative surprise, is when someone says durable goods orders are going to rise at 0.2% month on month, and instead they're minus 0.3. See, that creates an economic surprise. While at the same time, the data could actually still be improving, right? So that's the gist here. And then here's the same chart, just versus rates. So last time I had the dollar inverted, advanced by 2 months. And here we have 10-year bond yields, again, inverted and advanced by 2 months. But it helps you understand how it is that economic surprises can work lower. And it's just because financial conditions work with a lead. And interestingly, we saw exactly the same thing in 2017, triggered by the dollar surge in the fourth quarter of 2016. This upswing in the dollar led to tighter financial conditions, which in turn tempered economic surprises for a period of time, pretty much mirroring what we're seeing today. But then the scenario eventually flipped as both the dollar and rates came in lower, right? Which then economic surprises started to come in strong, and actually growth rebounded really strongly. I also believe, and this will be a chart you're familiar with now, is here we're looking at both the dollar and rates, right? So combined and the deviation from trend, that will soon begin pricing in more rate cuts into the forward curve. Now, I said earlier in the year when just one rate cut was priced into the forward curve for all of 2025, that was a shockingly low bar considering Trump's return to office. And we've since priced it in pretty much an additional cut, right? So we've got like 2 cuts priced in, about 2 into the forward curve. So that's already doubled. But I still think that there's room, and you can see the gap that opened up in 2024. So I think that there's room for this now, to come down. And while the president isn't supposed to interfere with the Fed, Trump has shown in the past that he's got no issue and is not shy of making his preferences known. And so I think that he's likely to push relatively aggressively for lower rates, framing it as it's necessary to boost growth, especially given that he's looking to deliver on, all of his campaign promises. And then when we talk about Vance, who aligns very closely with Trump's broader economic policies, he's too been very vocal on implementing policies to ease financial conditions and even using that word, financial conditions. So I think together they can exert significant pressure, political pressure for the Fed to act. And then I think the last point I'd kind of throw in there is that even though the Fed is on paper operating independently, they don't operate in a vacuum. And so I think the bottom line here is we're going to get more cowbell this year. And speaking of more cowbell, the recent move lower in the dollar has already triggered a fairly significant rebound in global M2 values. It's literally the mirror image of the Trump 2017 playbook at this point. And as we pointed out previously, 2017 being another prime example, global M2 has just come back to retest the breakout zone before pushing higher. And so this is a pattern we've seen play out many times over the years, which has always been an important signal to watch when it comes to Bitcoin and other risk assets. It's a signal we pointed out in MIT back in July, in the July report, right as it was breaking out. And since then, even taking into account the current pullback that we've seen, Bitcoin's up 76%. Okay, so not too shabby. Now, let's come back to growth. The absolute surge in Philly Fed new orders this January, if you've been following these reports, is exactly what we have been expecting. Now, as I had been pointing out, it's always the expectations components within the headline numbers in the regional Fed surveys that are leading, right? So throughout Q4, especially after Trump came in, we saw expectations in the regional Fed surveys quite literally explode higher. At the same time as that was happening, whether we're talking about manufacturing surveys, whether we're talking about consumer confidence, CEO confidence, in whatever it is, investor confidence across the board, when you look at current conditions versus expectations, current conditions were relatively muted, but expectations were skyrocketing. But again, as we had emphasized at the time, it's the expectation components that you want to focus on because that will eventually filter through into current conditions. And then if we speak about, coming back to expectations, when you bundle all of the Philly Fed expectation subcomponents, so here we're talking about employment, new orders, yada, 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 the outlook for manufacturing sector just hit a fresh 30-month high. And in my view, this lays the groundwork for the ISM to make a strong comeback this year. And we'll talk a bit more about that when we come onto the ISM in a little bit. Additionally, Philly Fed Capex intentions absolutely exploded higher as well. And this is a hugely positive signal because rising Capex intentions across manufacturing surveys like we're seeing here is a clear indication of confidence returning into the system. When companies start ramping up investment plans, it means they're positioning for future growth, driving productivity, creating jobs, and injecting, fresh momentum into the economy. So this kind of spike in Capex intentions is exactly what we'd expect to see in the early stages of a cyclical recovery. And it reinforces and facilitates a broader economic rebound because it starts to feed on itself, right? It's like a recursive feedback loop. Empire Capex intentions, also moved higher, not as dramatic as Philly, but still, hitting the highest confidence level since April of 2023. So I think overall, this is a hugely positive sign. And I fully expect this strength to build as we progress through the year. Now, then there's the NFIB Small Business Survey, which surged right in December. And here again, this was a move that we were anticipating. Why? Because as I have been pointing out, the outlook for general business conditions, which is one of the subcomponents, so that would be the NFIB equivalent of expectations, was going higher months before this did. What I think is also interesting is the last time we saw this kind of surge in small business confidence was December of 2016, right after Trump's victory over Clinton. So you can see I've highlighted both of them in those pink bars. That was December 2016. This is December 2024. So, and then we just went a little bit higher. But the point is that was for all of 2017, right? Confidence was choppy, but grinding higher. Okay. Let's talk about the ISM. So you'll remember this chart, again, had you been reading MIT, because there was a huge cohort of people that were sounding alarm bells when the ISM did its sort of this is ISM new orders, when the ISM rolled over temporarily. Very normal corrective phase. We see it all the time. It results in a higher low typically, or a double bottom. But what I was telling you that this was called at the time was a false dip. And so far, this is unfolding exactly as expected. This kind of setup is something much like with the global M2 chart we've seen play out time and time again. And I've highlighted one, two, three, four other times that this has happened. But if you extend this chart out, this is a pattern, I've seen many, many times, because don't forget, this survey goes all the way back to the 1950s. So it's just history repeating itself. It rallies off the lows, comes a little lower, and then kind of the big move in the business cycle happens. And now we've seen, in January, we saw ISM new orders rise to 55.1, which is the highest reading since May of 2022. And what you could have also looked at, that the chart is less pronounced now that we've actually have the results for January ISM. But had you been looking at this survey prior to the release, so here I've just composited Dallas, Philly, Empire, Chicago, and the others, and then taken a Z-score or the average, it was moving higher. And so you could have said, okay, well, I think as a result of that, in real time, because I have all composite regional Fed surveys, that the ISM should come in higher. And then if we start to do this business cycle dominoes thing and look out into the future, with ISM new orders finally back into expansion territory, this is good news for the headline ISM number, because new orders typically lead by around a month. Pop the hood as well. Now we have 9 industries reporting growth. Is it super strong? No, but you also don't want these things to be super strong, because if they're super strong, it means the business cycle is overheating. So this is like, Goldilocks level. The other thing I'm going to say about this is, back in January of 2023, if some of you who will have attended, I don't know if it was January or February, but Raoul and I and Andreas, we did our thing in New York, and I, of course, came in virtually. But this is a chart that I showed. We fell to zero. So 0 industries reporting growth. And my take, based on lead indicators and liquidity, is I had liquidity and the business cycle positive. And also, I was looking at all these charts, and these charts are contrarian indicators of the lows. And also, you can't really do a whole lot worse at 0, can you? You're at 0, can't go negative. So this, coupled with our larger framework, was why we were scoring growth from liquidity positive. But really, and I say this like, I don't know, humbly, we were really, I think, scanning everyone, the only people that were scoring that positively. And it's really about that combination of leads plus extreme readings like that. And you're just like, this is the time to shift. And that's when we wrote our article that the turn is near in November of that year, of 2022, the right year? Yeah, I think so. November 2022. So in GMI. And then we come out now. So now we're coming out. So we were at 1 month. Now we're at 3 months, right? So in terms of new orders to inventory, so the business cycle dominoes, very good print. So new orders to relative to inventories in January, new orders are outpacing. So I think this is a fabulous chart. Actually, it's a little bit volatile, but it gives you a sense of the overall direction. And it works as well if you back it out even further. I just capped it at 1985 because prior to 1985, the ISM swings could be pretty crazy and just makes the chart look a bit messy. And then, you go out even further and you come to our GMI financial conditions index, right, which is advanced by 9 months. And so, yes, financial conditions have tightened a bit recently, but when you zoom out and you look at the broader macro picture, specifically how much financial conditions have eased in aggregate since Q4 of 2022, it paints a much clearer story of what's to come. And so my view is, after this brief hiccup where economic surprises may come in a little weaker over the next 1 to 2 months, as a result of the recent rise in the dollar and bond yields finally taking its toll, we'll see strong support forming for the manufacturing cycle to really kick into gear later in the year. This year, even over the next coming months, right? And remember, too, that the ISM in January only just moved above 50. And we're still nowhere near late cycle levels that would typically trigger a macro regime shift into macro fall. So the danger zone, which I've highlighted there, which is a cross above the 80th percentile, meaning that there's still plenty of runway left for the business cycle to build momentum before the usual late cycle checklist, or my usual late cycle checklist, which I'm happy to go over at some point, but will start to flash yellow and eventually red, right, which would be macro winter. And what we know, as we've discussed now many times, the major moves in crypto, although I know it doesn't feel like it this week, but the major moves, zooming out, happen when the business cycle starts gaining real momentum. Okay, particularly when the ISM pushes above 50 and continues to climb towards its late cycle peak. So this is where we are. And, if you look at Bitcoin relative to the ISM, we're basically pricing in current ISM numbers, but nothing forward looking, which is what I just highlighted for you. So basically, we're just trading current ISM. It's the same thing with cyclical equities. So here we're looking at industrials, materials, financials, small caps, right? Current ISM, but nothing forward looking. Same thing with commodities, and carbon too, right? Carbon finally showing some signs of life. And I could show you 30 other charts, but, I didn't want to be here for 4 hours showing you all the relationships, but it's the same thing, right? Cyclical risk is a function of the business cycle, okay? And then once the ISM continues its slow grind higher to close the gap with our GMI Financial Conditions Index, that's when we'd expect alt season to really kick off. And by alt season, we mean the real deal, right? When alts start to seriously gain market share versus Bitcoin like we saw in 2020 and 2021. Now, is it a straight line? No, absolutely not. But again, it's about getting the trend, the direction of travel correct. Another major tailwind, and then we're going to shift to inflation after a few extra charts here, is another major tailwind, I believe, for a cyclical recovery in the global manufacturing cycle is the complete and utter collapse in Chinese bond yields. And you guys will have seen the comments I put around, or I put out on this, both on X and I included in an MIT report. I haven't agreed with a single take on this, but my take is just that this is a massive easing of financial conditions from the East. And what this then subsequently allows is once the dollar moves a little bit lower, the PBOC can begin to ease again, right? And they have the cover to do so because there's no risk of the economy overheating because the economy is still extremely weak. So, and they can do it in a big way if you look at this chart. Finally, with 75% of central banks currently in easing mode, the Bank of England just cut again today. The setup, I feel looks extremely positive for the business cycle this year looking out. And this will drive lead indicators higher relative to coincident economic indicators. So this is the business cycle dominoes. So it makes total sense given how the leads and lags of the business cycle tend to play out. So overall, we see plenty of reasons to be optimistic on growth for 2025. All right. So inflation. Let's do this. So with a cyclical recovery in the business cycle finally now coming into focus, I'd say, inflation is something that we now need to think about. That said, unlike many out there who are predicting a rapid reacceleration in inflation, we're sticking with our base case for 2025, which we laid out back in Q4. The idea is this: we'll see inflation, but it will be driven by a recovery in cyclical demand. And this means it'll impact certain areas of CPI while leaving others largely untouched. So let me explain that. For starters, it's pretty clear looking at the regional Fed surveys that price pressures are starting to tick higher. Okay, something we've been highlighting over recent months. And it's particularly evident when you look at the Empire Manufacturing Survey. So we're looking at prices paid. Well, it's not prices paid; it's all of them. It's prices paid, prices received, and whatever the other one is. Drawing a blank, but it's those all put together. And supplier delivery times. It's all those put together, and you can clearly see the trend is higher, volatile, but the trend is higher. Another way you can see that is if you look at the ISM non-manufacturing survey, right? So basing slowly, right, and maybe a floor for how much further inflation can fall. But on the other hand, inflation typically moves in stages. And the usual flow, which I've discussed, many times here, which just helps me compartmentalize the cycle. And it's the equivalent of business cycle dominoes, but for inflation, is commodity inflation is early cycle, which leads to good inflation, which is mid-cycle, which leads to services inflation late in the cycle. And generally, the EM PPI numbers are the first to move. So when you look at emerging markets, the link between PPI numbers and commodity prices is pretty clear. And you can see that on the chart just without doing any work. But these economies are often net exporters of commodities. So when commodity prices rise, the cost of production in these countries follows suit, right? And as raw material costs climb, the prices of goods that rely on these materials, be it industrial metals, energy, so on, also rise, which then shows up in their PPI numbers. So Essentially, these countries feel the price pressure sooner just because they're directly tied to the global commodity cycle. So this makes EM PPI numbers an early indicator of broader inflation. So you can see that this is already ticking higher. Now, the rise in commodity prices is also starting to spill over into core goods inflation. It's still early days, but as commodity prices push higher this year, driven again by a cyclical recovery in the business cycle, one of the first places that we'll start to see inflation show up is in goods prices. And goods prices lead headline CPI by around 4 months. However, for now, if we look at the base effect, it remains relatively muted. And that's likely to change if once commodities start to pick up. But for now, if we look at what's happened over the recent weeks, oil's still coming down. And that makes me feel like goods inflation can remain relatively muted for now until the ISM, let's say, pushes above 55 or so. And I think that this is the really key point here when we're talking about overall headline inflation numbers. For the headline number to move higher, we'll need to see goods move, spike significantly, especially since goods inflation is only 18% of total headline CPI. Food is another area we need to watch this year because fertilizer prices, again, a function of the business cycle, have started to rise and they lead food prices by around 8 months. However, once again, food is only 13% of total headline CPI. It matters, sure, but there's a major offset, which I'm about to show you now. Okay, here we go. Business cycle dominoes. So the caboose of the business cycle train is always core services, which lags the business cycle. And here, when I talk about the business cycle, I'm talking about the ISM by around 15 months and makes up a massive 62% of total headline CPI on its own. It's incredibly slow moving. And while most old school economists like to refer to services inflation as sticky, meaning it still stays elevated for long periods of time before it starts to come down, that's not really what's going on here. It's simply so far behind in the cycle that it takes time for the slowdown in inflationary pressures to hit services inflation, which, as I mentioned before, is largely a function of unit wage costs. And speaking of wages, right, there's still zero signs that wages are going to be picking up just yet. Our GMI wage growth tracker did a fantastic job last year at cutting through the noise, especially when you had most macro strategists out there talking about a rise based on small business confidence or wages accelerating. We, of course, immediately shut that down in these reports based on, quite a few of these indicators. And then when you look at the NFIB survey on compensation changes over the past 3 to 6 months, wages continue to collapse. But then I can already hear, and I included this in the report, someone say, yeah, but Julien, compensation plans are leading and therefore aren't we going higher here? And I'm like, no, I'm just not buying that right here, largely because of our lead indicators. And the one I showed you earlier, the GMI wage growth tracker, is, of course, it's not the only one we have. But to me, this is already the beginning of the fourth head fake. We had the first one, second one. The third one, by the way, was the one when everyone was talking about wages reaccelerating on the basis that compensation plans for small businesses were heading higher. And again, we were focused on the leads and we said, no, it's not quite the right time. And that's the point. It's just not the right, I've explained this in detail in the reports, but it's just not the right environment for a material and sustainable reacceleration in wage growth. It will come, but it comes typically much later in the cycle. Now, coming back to core services inflation, shelter inflation is the largest subcomponent of core services. So it makes up 37% of total CPI and accounts for around 60% of that core services number. So it's a really, really big chunk. What we also know about shelter inflation is that it typically lags home prices by around 17 months, meaning that for 37% of total CPI, it's pretty much going to be one-way traffic for all of 2025. And we see a similar picture when we look at the Cleveland Fed new tenant rent index, which absolutely nosedived in Q4. The point being, and why this all matters, is I believe we'll see core services decline for most of 2025, which will drag the core CPI number lower as well. And this will give the Fed the cover that they need to lower interest rates further. And remember that the Fed is focused on the most lagging elements of inflation, which is why they're almost always late to hike, they're always late to cut, and they continue cutting well into the initial rebound of inflation, where inflation is essentially a byproduct of stronger growth driven by a cyclical recovery in the business cycle. So, and another thing to note here is the base effect is also quite favorable over the next 1 to 2 months. So the base effect is that dotted line, so sharply lower. And base effects aren't everything, and they're never a guarantee, which is why I don't use them to forecast the quadrants. So, I use them as like an assistance if I need them, which can be helpful. But, if you think back to, as I say, Q1 of 2023, the main people that do that, because the base effect was still negative, were expecting growth to continue lower. And so it's difficult. But the point being is that it helps when dealing with probabilities, but there's no certainty. But just to highlight that the base effect's quite negative. A few final points on inflation that we're going to skip onto the next section. Firstly, if we exclude shelter from headline CPI, so the most lagging stuff, which by the way is still propping up the headline number, CPI is already below the long run average of 2.4%. Secondly, there's still no signs of CPI breadth ticking higher for the time being. So with respect to policymakers and higher interest rates, I've discussed this before, the time to worry is when inflation breadth starts to broaden out. So we see, a larger number of the components accelerating, so above that average line. And this is typically a macro signature of macro fall, but not of macro spring or summer. Thirdly, the Fed have given themselves a huge range to maneuver this year. So I think as long as we don't see a significant re-acceleration in core PCE and a move beyond the high estimate of 3.2% for 2025, I don't really think rising inflationary pressures will be a roadblock for the Fed to ease rates further this year, especially if we see weaker economic surprises over the next 1 to 2 months based on what we've discussed earlier, be it the dollar and rates, and that being leading 2 months versus surprises. However, and here's the big picture, based on, again, zooming out, the significant easing of financial conditions since Q4 of 2022, I do expect us to see some inflationary pressures building later this year. There might be some short pullbacks in the second derivative of CPI, like we saw last year, which nudged us back into macro spring, when the second derivative moved lower, driven by patches of tightening in financial conditions, which you can clearly see on the chart, which I had illustrated at the time. Yet once the white line crosses above zero, it indicates that CPI numbers are going to begin to rise again. But considering everything I've just outlined, along with the various dynamics of inflation and all the moving parts, I would say this will become a more meaningful story in the second half of this year than for right now. Either way, it's definitely something that we'll be tracking and keeping an eye on, both in the video updates and the written reports, right? So we'll just track this month by month. But, for now, based on what I've just outlined with shelter, I think this is a story for later in the year. But at the end of the day, right, a rising second derivative in our inflation score, coupled with a modest rise in our composite growth score for December, keeps us in macro summer, for now. And I believe that this is precisely what classic cyclical equity recovery plays are starting to pick up on. So I had mentioned a few earlier: industrials, materials, energies, financials, small caps. That they're starting to react to this, and all of these styles and sectors have outperformed the S&P 500 year to date. And historically, these styles and sectors tend to be the biggest beneficiaries during periods of macro summer when the business cycle, right, is improving, because now earnings are starting to improve. So it won't be a straight line, obviously, but macro summer is typically a favorable environment for risk taking. So next section. In macro summer, dips are for buying. So I updated all these charts from when I released the original written report. And, what we saw at the time was bullish sentiment collapse when looking at the AAII survey. It's since recovered, but by no means are we extended. So, we're not overly bearish. We were at the time. We're not overly bullish either. It's sort of like neutral. which I think fits really well if you look at the CFTC positioning on the S&P 500. It's basically flat, which means that speculators are at neutral beta risk, meaning that they're not really taking a view on the direction of markets. They're pretty much flat. We were slightly short last week. We've since covered that short, so we're at 0.2%. But the point is this is flat. So there is no real view being expressed here, which I think is interesting based on kind of everything. I think nothing changes sentiment like market price. Okay, so the fact that crypto is a little bit lower, came down a lot lower, and then equities rebound, corrected a little bit, which I'll talk about in just a second, I think has people neutral on risk. But if I outline the big picture macro as I've done for you here, I think we're in a positive environment. Now, this chart, again, is one of the ones I included in the report. At the time I released it, I think, what do I have here? January 9th. So the January 9th MIT update, we were at 22%, which if you think about RSI, this is 50-day moving average, anything below 30, like the RSI, would be oversold, okay? So 22%. And since then, equities are still, if we're talking about the S&P 500 and the NASDAQ, they're still up 5% from that oversold reading. So currently we're at 50%, but again, 50% looks exactly like speculative positioning and exactly like the AAI survey. We're basically neutral. So there's no screaming buy signal here. There was, as I say, on the 9th, right, if we're talking about equities, but there's also no overbought signals in place. So I just wanted to outline that. But then if we zoom out, right, our GMI Bitcoin cycle top finder is just still nowhere near signaling a peak in Bitcoin prices, and nor do some of our other indicators. So here's, core risk indicator, which is basically just a series of oscillators grouped together and ranked in the Z-score. Again, I always make fun of this name. Who names these things? Me. Our Bitcoin valuation model, again, here, it's just a percentile model with a bunch of factors. And from a quantitative perspective, it's not the cross above the 90th percentile that forces you risk off, right? It's actually the cross above the 90th and then something like a cross below the 85th percentile. And that will then flash red, but just not there. And then returning to this analog, I still believe it makes a lot of contextual sense for this year. Expect frequent pullbacks, some of which could even last a couple of months if you look at the 2017 cycle, because this is the 2017 cycle, just shifted by a couple of weeks. But this is the roadmap that I think, Raoul and I have in our heads for this year. Choppy at times, yet ultimately a slow grind higher. And this doesn't only apply to Bitcoin. It applies to risk assets more broadly. And so here's the 2017 cycle. So a reminder of what we did back then, which mirrors exactly what I just described. Choppy at times, but ultimately it was a slow grind higher. So very much, as I say, the pattern we're anticipating this time around. And then there's this chart. I like to bring this back now and again because everyone's tweeting about valuations. And historically, as I said before, valuations within a quantitative framework have only flashed red 5 times since 1980. So they've only been a problem 5 times historically, looking back to 1980. And so as the ISM moves higher, earnings, we know, will begin to improve. And this will justify the 2023-2024 valuation premium, which has been baked into equities over the last couple of years. So what that does is that if earnings start to rise, that then pushes that teal line higher, as I've discussed before. The problem, within the macro process that I'm running, when those two lines intersect or they cross each other, that my valuations component flashes red. We're not there yet. But as earnings start to improve and we justify the valuation premium that's baked in equities here because they are rich, that the teal line will start to grind higher, and that'll give us more runway for risk assets to rally, I believe, as we progress through the year. So, this is probably the most important segment of the entire deck. And I specifically put it together for you guys because I got a lot of questions about this, and I also had to make sense of it for myself. And this is the way I've made sense of it. So you'll be familiar with the 4-year cycles that we put together. Okay. Well, a lot of people have talked about this, right? So you have spring, summer, fall, winter. So the crypto seasons. Now in 2013 and 2017, we had a big run. right? But then if you look at 2021, this was the cycle that, which caught a lot of people off guard, because a lot of people were thinking that we're going to have a redux of the 2013, 2017 cycle. And instead, it ended up being this truncated cycle. So in Q4 of 2020, I remember being in Geneva and giving a presentation, which I talked about this, giving a presentation at the Four Seasons Hotel titled Dancing on a Volcano. So the time I was still managing money, but I could see lead indicators were rolling over. I'm going to show you this in a second. And because it was my job to take risk as an investment manager, I had to still dance, but I knew something was coming. And as I say, I'll show you this in a minute. And really what happened is that because of COVID, the base effect, you have to remember that the ISM is a diffusion index, but it behaves like a year-on-year comp. So the fact that the ISM fell to 41.8 like that means that from a year-on-year comp perspective, all the comps, when you look at all of them, and then it went to 63.8 like this, it just shot back, which meant that the ISM accelerated from 41.8 to 63.8 in basically record time, which shortened the business cycle. Okay. And when we look at the last 3 times, so here we're looking at exactly those 3 cycles, right? 2013, 2017, 2021. Bitcoin, and I capped the white line a little earlier because that was actually the peak. So it peaked just a little bit before the ISM. But the point here is that Bitcoin actually did an 85x. Wow, right? In 2017, it did a 46x. And here we're talking about from the minute the ISM crossed 50 to the late cycle peak in the ISM. And then in the 2021 cycle, it did an 8x. So it's like, all right, well, what gives? Well, what gives, and the reason, I had already seen that we were going to get a peak in liquidity is because I was, again, here using base effects. And I could see that in Q1 of 2021, based on the projection in the rise in global liquidity and then the subsequent peak and the deceleration. Plus, this was like 4 standard deviations historically, that liquidity would start to drain. Right? And look at this. In March of 2021, liquidity peaked and went down in a straight line. Here, we're still negative, and actually we're starting to base now. So this is not the updated chart. So that we're actually a little bit higher than we are, a little bit higher today than we are right here. And then look at this. Guess what else peaked in March of 2021? The business cycle. So the business cycle and liquidity, the 2 most important drivers of, as I pointed out, crypto, equities, credit, commodities, right, across the board, right, risk assets across the board had peaked and was slowing. Okay, and here was another reason why in Q4 of 2020, you could see that the business cycle was about to decelerate. So here we were at 60.2. This is actually a snapshot from back then, right? If we had been sitting together in Q4 of 2020, this is the chart that you would have seen in the pack, and it was suggesting that the ISM was about to, quite literally, fall off a cliff. Whereas today, the ISM is just now moving above 50, and financial conditions suggest that we're going higher. Additionally, liquidity, right? We're expecting, based on our views around the dollar, also what happens with China, as I mentioned earlier, that global liquidity, or global M2, both from a private and public standpoint, will improve, as we progress through the year. Let's also not forget that during the last Trump cycle, there was that air pocket in January, something we've discussed, where crypto fell like 27% in 7 days, and then it just went on to 23x. I think I said crypto, Bitcoin, went on to 23x over the course of that year. Now, I'm not telling you that Bitcoin's going to 23x. What I'm telling you is that if we're right about the backdrop in this environment of weaker dollar, rising liquidity, ISM moving higher, right? Well, at the same time, Fed's backward looking. So they're focused on core inflation instead of commodity inflation. And they're also not focused on the ISM. They're focused on labor market indicators, which lag the cycle by, 4 to 5 months. This is a good environment for risk taking. So, of course, I have to show this chart. I think taking all of this work into consideration, we believe 2025 is going to be a good environment for risk assets. And that we're still in the early stages of the banana zone. So you're going to look at this past week. How can it be the banana zone? Look at this chart. If you zoom in, you can see that right around now, we always get these pullbacks. And the banana zone is never a straight line. And at times it's going to feel like the end of the world, But the banana zone officially kicked off last year, right? On the breakout of global M2, which we had been showing you at the time. Now, I'm going to echo what I said in the monthly report. And Raoul and I have said this many times. 20 to 30% corrections are the norm here. This is a 70 vol asset. Expect them, embrace them. Well, you don't have to embrace them, but expect them. And if you're in a position to, add on dips, do so. That's what I did on Monday. Now, as I said, do we retest the low? That happens. Okay. So I added to my core convictions. If we go lower, but I didn't deploy all of my cash, right? That's you don't do that. Well, if you got really big cojones, you could do that. But I've got, medium-sized cojones. But so I deployed a little bit, not all of it. So if we come back to the low, I'll add because of this framework, right? Because of where I believe we are in the business cycle. So, I hope that this video update has been, as always, helpful for some of you in thinking about this week and thinking about where we're heading this year. It gives you an idea of what we're thinking in terms of growth, inflation, liquidity, the Fed, and kind of how that all plays out. And why, and also just illustrating some of the market dynamics and illustrating why it is that we maintain our bullish stance, for the year. Now, rest assured that Raoul and I revisit this data. I mean, whenever it's coming out, we're looking at it, right? And so we're going to be constantly reassessing our view of things as we progress through the year in these video updates and in the written reports, right? That's what we're doing. And I said this in the roundtable as well. Perfection isn't the aim here. It's consistency. It's coming back to the same set of indicators month in and month out, saying, okay, where are we? What's changed? And then it really, something I got a lot of at the crypto gathering was this is a kind of framework which helps people sleep at night. And that's this. I put this framework together for me. And the thing is that, I mean, if I wasn't writing this and doing this for you, I'd be doing it for me on a monthly basis anyway. And so writing and talking about it is helpful, right? Because I've never really been a writer. I've just been an investor. But then it's focused me to flush out some of my thoughts. And what I realized is that, when I originally joined Raoul and I had to make sense of crypto within a macro framework, I had to really simplify things for me to make sense of it. And this is what I feel like we've done here. So again, we'll assess this as we go through the year. I say this all the time that, this is MIT. So as the data changes, so too will our views. So anyway, look, good luck out there. Take care. No FOMO, no leverage, and see you all next time for the next monthly MIT video update. Take care. Bye.
So listen, you can see the quality of work that Julien does and why I'm immensely proud to work with him. Global macro investor, and then within Real Vision Pro, and also within the macro investing tool itself. This kind of framework will literally change your life. And I urge you to get a framework to make you a better investor. Come across the Real Vision if you haven't, or just sign up for the macro investing tool if you're at Real Vision, or it's also embedded within Real Vision Plus. I think you will find it incredible. All right, see you next time.
Consensus Hong Kong 2025 is where the global crypto community converges to shape the next era of Web3. From February 18th through the 20th, Hong Kong becomes the meeting point for leaders across finance, technology, and digital assets. This isn't just a conference, it's where deals are made, partnerships are forged, and new opportunities emerge. Consensus features exclusive networking lounges, expert-led sessions, and invaluable insights from top industry voices. Whether you're expanding your network, building your brand, or closing your next big deal, this is the event that moves markets. Visit CoinDesk.com/consensus-HK to secure your spot and use Real Vision 15 for 15% off. Don't miss your chance to be part of the industry's defining moment.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.